Hi everyone, my name is Nausheen Zainab, and I would like to welcome you all to KiwiTech's exclusive venture capital panel. Today we have a fantastic panel discussion on the rise of micro VCs and angels, opportunities and challenges for early stage startups, followed by 5 high-value growth stage startup presentations. For those of you who may not know about our events or are joining us for the first time, welcome to KiwiTech Events. We will begin with our events ecosystem in 2017 as part of providing networking opportunities to our founder partners, and the goal was to introduce some of our strongest founder partners to our network of investors around the world. In fact, to date, we have hosted events in over 15 cities throughout the United States, as well as 3 international locations including Toronto, Qatar, and Riyadh. And with that, I would like to welcome Mohsin Syed, President and Chief Startup Officer at KiwiTech, to provide an introduction to KiwiTech. Over to you, Mohsin.
Notion, thank you. Can you see me? Am I audible?
Yes.
All right, let me just share my screen real quick. Right, is my screen all good?
Yes.
All right. Thank you, everyone. Good afternoon, good evening, good morning to some of the folks who are starting. Right, I think we have a couple of guests from Japan who I believe have dialed in as well. So really appreciate everyone to be on this, what happens to be the 25th Venture Capital panel hosted by KiwiTech in the virtual format. We do these events in a post-COVID as a combination of both virtual as well as in person. As Naushin mentioned, my name is Mohsin Syed. I am the President and the Chief Startup Officer here at KiwiTech. I know that there are a lot of guests here today who know a lot about KiwiTech, who've been with us over the last 15 years as we build the program and ecosystem. But for those of us who are joining us for the first time, or those of us who do not know us well enough, here's a quick overview of what we do, who we are. So KiwiTech is essentially a global ecosystem of entrepreneurs, innovators, investors, mentors, and corporations. We take great pride in not just being the world's largest technology service for equity program in the world, but I think what we take real good pride is being the most trusted partner when it comes to building early and growth stage ventures over a span of that very critical initial phase in an entrepreneur's lifestyle. So today, we are home to more than 600 portfolio companies across 20 different industry verticals. They are ably supported by a fantastic network of 3,000 plus investors. And these are your angel investors, VCs, family offices, seed stage VCs. So effectively, we've been able to raise about $150 million of capital across our portfolio companies, in addition to our own investment of about $150 million of technology services across them. Equally contributing to the success of our entrepreneurs and the success of our ecosystem is a completely committed and engaged group of mentors. Now, these mentors are drawn from various walks of life. These are entrepreneurs who have had exit stories. These are entrepreneurs who've had and scaled large corporations. You have corporate VCs who are part of these mentor groups. You have angel investors, family offices. So it's a fantastic group of people that network and whose belief system lies in empowering entrepreneurs and innovation. So today, if there is someone in the audience who would love to be part of our network, specifically as a mentor, please feel to reach out to us. And the binding factor, the stickiness that has been part of our culture has been to build this ecosystem with events like this. We believe that events, carefully crafted, engaging events, events that respect the confidentialities of innovators and their products that they're working on, investors and their TCs is very, very important to us. And we take great pride in putting together a fantastic group of events every year. We average almost about 2 events a week. So if you're looking for a specific event in innovation, in entrepreneur ecosystem, I think we have that for you. Now, the success story of KiwiTech just doesn't start with KiwiTech. It starts with our previous venture. The founders of KiwiTech scaled a 4-member startup back in 1989 to becoming the world's largest technology services company in content and publishing. So the travails and the tribulations of building a startup venture, taking it to $1 billion plus in valuation, and finally having a 9-digit exit is well understood as a way of life. It's entrepreneurship is lifestyle for us. Entrepreneurship is family for us. We understand how we did that in the previous venture. And a lot of this, what we do today with our entrepreneurs, investors, and our ecosystem are the learnings from those ventures that we have built together. Now, as we progress, we've done a lot of stuff contributing to the ecosystem and learning from the ecosystem. This has always been a very dynamic environment of receiving and giving back. So today, at this point of time, as you know, we are the world's largest technology services for equity program. We also are very constantly listening to the growing demands of the early and growth stage entrepreneurs. So as a result of that, we've been able to acquire other additional shared services companies to provide not just technology services and fundraising assistance, but we also have one of our sister concerns who provide finance and accounting services for early and growth stage companies. We realized the growth of emerging tech, and as a result of that, we acquired an enterprise which specifically is a center of excellence in Web3, blockchain, and fintech. And we're also looking at 2 more acquisitions this year, which will further help our entrepreneurs with their emerging technology, marketing, and other services needs. The goal is, as we grow this ecosystem, to be able to have at least a portfolio of 100 startup companies that exit at $100 million or more. And I think we are well on the track to achieving that by 2026. We're almost about 1/3 in terms of the number there. Now, everybody talks about what does the technology services equity model look like. So if you're a startup which is looking, and this came from the genesis of fact that a lot of startup entrepreneurs today are non-technology founders. So either you tend to overspend or you tend to underspend on tech. So to solve this problem, almost 15 years ago, we realized that the best way to do is convert those technology services into an investable asset. And that's what we did with our tech for equity model. So in a startup life cycle, when you look at it like a 3-year window or a 4-year or a 5-year window, you typically end up spending about $500,000 in technology services. So with the KiwiTech model, the way we work with our entrepreneurs and investors is be able to fund half of those technology services in exchange for equity position. So one, we are aligned with your interest. We save cash, which is extremely, extremely critical and a valuable asset. And we are able to work the business to a very strong technology vantage point for investors or cash investors coming in to help them on the marketing side, key hires, and so forth. Now, we do definitely love the numbers, but all of these numbers also show a lot of quantitative parameters that we focus on. We look at a lot of deal flow, and this is a glorious example of numbers that we've gone through. More than 200,000 startups over the last 5 years to arrive at a portfolio number of 409. So that's 0.02%. So that's why we're very passionate about the entrepreneurs that we bring in. Today, you're going to see 5 of those finest from that 409 that you're going to see their stories. Now, the entire ecosystem, to sum it up, the key stakeholders are our entrepreneurs, the portfolio companies, the investor network. We work with local partners, regional partners. We have a variety of partners, whether they are incubators, accelerators, and the corporate community, and giving them that support that's needed for all of us to come together and provide technology, finance and accounting, marketing, and specific centers of excellence where it's needed. And all of this is driven with the underlying principle of making sure that we are impacting local communities. That's key part of what we do at KiwiTech. And the best way to help those local communities is to bring in global talent, is to bring in global expertise. Now, the ecosystem of events, as I mentioned to you, we have an absolute great palette for that. We are also focused on a lot of theme-based events. We are focused on underrepresented founders. We are focused on emerging tech. And today, I love to hear through this panel because this is going to be a very exciting one. My colleague Ike Syed from Washington, D.C. is going to moderating to it. We have Lindy, Christian, and Damodar, who are absolutely exceptional in terms of what they have done and what they have contributed to the startup ecosystem across the world. And also we have 5 fantastic KiwiTech portfolio companies presenting to you. So thank you so much for joining us from all parts of the world. Again, welcome to another fantastic KiwiTech event. Over to you, Nausheen.
Thank you, Mohsen, for the introduction. Now, without further ado, I would like to invite Ike Sayed, SVP of Strategic Partnerships, KiwiTech, to start with the panel discussion. Over to you, Ike.
Wonderful. Nausheen, can you hear me and see me?
Yes.
Fantastic. All right. Would request my fellow panelists, Lindy, Christian, and Damodar, to turn their videos on so our audience can see them. Wonderful. Great. And I know they're joining us from all of them from California. Actually, that's the first. Usually we have folks from around the country, and we've got a good mix of East Coast and West Coast, and maybe that's indicative of kind of where micro VC funds and angel investors are headed today. So with that, I would love to kick it off. Let's see. And we can go alphabetical by last name. Maybe start with you, Christian, going on to Damodar, and then on to Lindy. If you can maybe introduce yourself to our audience, share a little bit more about your fund or what it is that you do today, kind of your background in micro VC as well as angel investment, that would be wonderful. And then we can get started with the panel discussion. So with that, Christian.
Sure. I mean, the obvious, I spent the first 30 years of my life in Europe. I was a lawyer over there, specifically was general counsel of one of the first internet service providers. We got very lucky to sell the company 6 weeks before NASDAQ hit its all-time high. So that's when I left Europe and left the law and became a VC in Southern California. So that's now 24 years ago. And ever since, I've focused on the same theme. And I'm very much a contrarian in our technology space, to the extent that I claim that we actually never built the World Wide Web, and that we still need to finish that particular project. And that has been my focus for the past 24 years. We have different vehicles, how we address that. So Sasani Capital is the headline for a group of entities. We have a family office with a private investment. We have a hedge fund where we build all of our technologies for that topic. We have our own Skunkworks division for experimental development in the space that people call Web3, a term that I also disagree with. We do a lot of educational work, partially with governments, and then also some not-for-profit work in Africa specifically. And that should be enough for the introduction.
Wonderful. Damodar?
Hi, this is Damodar Reddy. So yeah, I'm with the Chemical Angels. Chemical Angels is a nationwide network of angel investors, primarily focused on investing in material science-based companies, whether it's in clean technology or in life sciences. So we actually have a 50-50 distribution between those two sectors. So we actually have a fund where we invest through, and also individuals add their individual investments. So just like, and we are not geographically limited, even the number of our members are in California, but we are across the globe, across the country, and with investments actually spreading all over the US. And personally, I'm originally material scientist by training, spent many years working at large companies like Dow and Rockwell, and then did 3 startups. I founded 3 companies in the Bay Area, and all of them material science and clean tech space, and sold my last company 3 years ago, and retired and moved to Southern California for some sunnier skies here. So I'm also an LP in a $30 million VC fund out of Irvine, California, called Co-Fund, where you invest in many different technology-based companies, primarily based in Southern California. So that's my background. Yeah.
Lindy?
Fantastic. Thank you for that. I will jokingly say that I'm a reformed Wall Street investment banker. Spent the first 20 years of my career doing mergers and acquisitions, especially for privately held and family-owned companies. Moved out to San Francisco, over 15 years ago, and you can't help but catch the bug when you get out here, which is angel investing. So I'm an angel investor, an advisor to well over probably approaching 20 companies now. But always fascinated by strategy and where companies and industries fit, into the larger picture, and became co-founder and COO of Guys AI, which is an edge AI software solutions company. We're global, and we primarily focus on industrial manufacturing and energy. But have had the pleasure of knowing the KiwiTech team for many years and watching what has now become an incredible, prolific portfolio. So pleased to join all of you today.
Thank you for that, Lindy. Really appreciate it. All right, we'll dive right into it. Again, very helpful to get that background on KiwiTech from Mohsen. So thank you for that. So again, focusing on micro VC funds and angel investors today, I think one thing that would be helpful to kind of level set is what do we mean by a micro fund? Again, I'm posting a link here from Forbes, .la, where essentially a micro fund, I mean, PitchBook and CB Insight calls it any fund coming in under $50 million as micro, whereas Crunchbase says that it is sub 100 million. But if you look at the actual numbers coming on from PitchBook, typically, if you look at a micro fund, it's a fraction of that size, on average about $15 million. As well, there seems to be a significant overlap between what micro VC funds and what are called specialist venture funds. And so there seems to be a greater and greater overlap of micro VC funds being less generalist and more very subject matter expertise. And again, I'll put this prediction from December last year, and this is from Forbes, where folks were predicting that micro VC funds will be the rage as, again, funds will become more specialist over time. Again, I'll copy and paste. This was item number 12, where they're saying 2024 will be the year of the hyper specialist VC. Just again, in terms of what was happening with AI and LLM. So with that said, again, maybe we'll go in the reverse order here. And Lindy, maybe you can start with a little bit about sharing your thoughts in terms of, again, as you look at angel investing, as you look at micro VC investing, do you feel it's getting more specialist over time? Do you feel that, or do you feel maybe it's going in the opposite direction, that is becoming more generalist over time, again, as the number of fields continue to proliferate, continue to diversify? Would love to hear and feel free to disagree. That's completely okay. Again, folks are hearing what's happening maybe in the material sciences industry may be different than what's happening in Northern California with AI and SaaS, and which might be different from what's happening again in Europe. So again, audience would love to hear your thoughts. Lindy, maybe we'll start with you.
There's definitely a bifurcation in that there are specialist, smaller funds as well as angel groups, and there are also the general ones. I don't know that has shifted. I think what has shifted is the amount of wealth and the number of investors that are coming in, and the growth of people interested in angel investing and moving out of larger funds and creating kind of these subspecialty funds. So I don't know that the type and mindset has shifted, but I definitely think that there's a significant growth in terms of that. I think what also has shifted, though, and are some of the more established angel groups, and I'm really fascinated to hear what Damodar is going to say here. But the more as markets shift, appetites and what we can get for terms in the companies that were going and has shifted as well. And there are a number of angel groups where typically you would think of angels as, just past friends and family. They're the first ones coming in. You get the most because you're taking on the most risk. I've seen a lot of angel groups, really moving towards post-revenue investment, and that's a significant shift. And if I put my operator hat on, for a second, it's making, that those early stage investments, you really better have the people around you believing in what you're doing, so that you can achieve a larger friends and family round to start off. So I'll pass it back.
Interesting. Damodar?
Yeah, so obviously, I mean, there are every part, whether it's angel group or micro VC or traditional VCs, there are always some groups which are heavily focused on certain sectors because of their partnerships, who are the partners, and also the LP base. So some LP base require them to be investing in certain sectors only. So I think, but I think what Lindy is saying is true. There are actually now a lot of individual investors who can write big checks, $250,000 to $2 million checks, and they're actually influencing significantly how some of these early stage companies are funded. So I'm actually involved with a company where we're funding them. They have received $8 million from one individual. They're super rich individuals. So there are not too many of them out there, but they are influencing the culture of investments. I think they take a lot of risks, personal risks, if they know the space. So the critical thing is they have to know the space, and all other business aspects have to come together. So, and also I think so when I was an entrepreneur raising money, so first company I raised money, I just went with the PowerPoint slides and had a $4 million round closed relatively easily. This was 20 some years ago. Now to get an angel investment, you need a product, you need revenue in near term, not 5 years from now, and an MVP, which is very well vetted and proven and tested by customers. So this is really the maturity of the companies that come to raise money is very different. And as a result, I think they're already, so I think, so there's a lot of change in dynamics. So I think, so because problems we're seeing right now is a lot of our funds we're investing in the last 3-4 years, putting money into seed companies, they're having trouble raising that critical Series A. That success ratio going from seed to Series A is extremely low currently. So that's a major challenge facing the industry.
Wonderful. Christian?
Yeah, so we did a very long exercise before we ever instantiated our fund, and just basically took a first principles approach, looking across all asset classes to whether or not VC was the most interesting way to allocate capital. And then once we decided on that, we built an actual thesis for that topic. What I mean by that specifically is a lot of VCs, again, anecdotally, have a theme rather than a thesis, meaning they commit to the buzzword of the day and kind of start paying social media company and producing a lot of content. That was not our approach. So internally, we actually publish our own thesis paper, share these for peer review. And whenever we talk to startups, we look at this as a peer review process. In essence, that startup is running an experiment on a thesis that we have on a particular topic. And then they are specifically, what's important to us is that we address problems for the real economy. So what I mean by that is, if you're looking at those legacy companies that came out of what's called Web 2, they're not really part of the real economy. What I mean by that is the real economy is the exchange of goods and services. And then there is adjacent functions that facilitate the exchange of goods and services, Google being a very prominent example. The world will go on just fine if there's no Google tomorrow. right? But the world is not fine if there's not enough food in the world. And there specifically, we immediately realized that the legacy financial complex basically extracts upwards of 30% from the real economy. So the very simple example that I usually make for people to to understand this is when I first moved here in 2000 and I called my home office in Hamburg, a call to Germany cost $1.15 per minute and was metered in 15-second increments. So a call back then, half-hour call, cost me as much as I pay right now for my entire monthly service for phone service. And so this particular situation was created by one protocol, by SIP, the Standard Initiation Protocol, commonly referred to as Voice over IP. So the point there being is we have a lot of new technologies that are not being applied in an efficient way to the real economy, solving real problems. So our first question, the reason why we call ourselves Sustaining, it's not kind of this virtue signaling way of we want to invest in kind of green and sustainable solution, although we do that too. It's more to the extent it has to be overall sustainable. And what I mean by that is we don't think that purely extractive models are sustainable in the long term because they don't serve the real economy. Because ultimately, the law A of requisite variety will always apply, as in if you work in a networked societies, the lowest common denominator or the most efficient system, most adaptive system will overrule every other solution that's commercial. So going back all the way to the web server that IBM was selling, that is obviously never took off, but then going down the stream to all the services that we quote unquote use today for free. Anyway, so larger point there is, and I give long nerdy talks about that, so stop me anytime. I think what we failed to do is to build what I refer to as the agency attribution layer, specifically to digital technologies, in order to actually account for all the externalities that these technologies have. So what I mean by that is if you're building a widget and it has certain externalities where people injure themselves or it pollutes the environment, what we typically take action against that and account for that. So we have failed for a long time to do this for all digital solutions. And I include everything that's using a database today in that. So the largest opportunity today is do away with ledgers, do away with database solutions. So for me as an investor, I take a very first principles approach, looking at what people refer to as AI, which is, to me, is a non sequitur. Intelligence is a unique human quality. But the point there being is we need to create this rights framework for everybody's bytes that these entities are holding hostage right now, right? So that there is no legal, no ethical, and more importantly, no technical reason for that to exist. And on a basic cybersecurity perspective is also not defensible. Anyway, I'm going to stop there. As I said, I'll give very long nerdy talks about that because that's our fundamental focus. And from our perspective, all of these other solutions then that making use of data, quote unquote, are downstream from the ability to actually create property rights for your bytes. And we haven't done that yet, but we see a clear path to that.
Wonderful. I'll post a link here from Crunchbase from earlier this year. And some really incredible numbers, just kind of, how the year started and what some of the predictions were given sky-high interest rates. So this came out in Q2 of this year. And what it mentioned was that first quarter startup investment globally had their second worst quarter since 2018, so in 6 years. And the reason it was the second worst quarter was that the quarter before that, which was Q4 of last year, was the worst. So while it ticked up slightly from where the Q4 was, overall, again, it was pretty dismal in terms of where overall VC investments were. The article then goes on to say that, early stage was actually a silver lining in that the investments in early stage, whether it's micro VC funds, especially angel investments funds, did go up slightly, again, just given the overall backdrop. And so my question to you is now, again, as we are sort of midway Q3, heading into Q4 and obviously an election year, kind of how do you see the state of what micro VC funds will do? Do you think, again, they'll pull back, they'll be more cautious, as well as angel investors? Is this the right time for startups to be reaching out to them? Maybe wait till the end of the year? What are your views on kind of, again, as you see the state of, the industry, so to speak, and, kind of where things are headed? And maybe, Christian, I'll stay with you and go in a reverse order this time, going to Damodar and then Mindy.
Yeah, I'll try to keep that very short. I mean, we stay away from anything that's popular. Essentially, for me, that's a counterindication. If things get very popular, then like everybody believes that, for me, that there must be wrong, so to speak. So it's very much the opposite. And I think to some extent, the picture that you're showing is obviously somewhat skewed based on probably an 80-20 distribution from certain funds that probably kind of raise too much money from limited partners, and that kind of distorts the overall picture. So there is some happy medium to where you can actually build sufficient deal flow and like sufficient expertise in a topic that then leads to a certain amount of money that you can actually usefully allocate, right? Because it's very different if I invest into a large infrastructure project, and we're looking at some of these right now, and it starts at $1 billion to just build that particular infrastructure. But then what we wouldn't be interested in is in like investing in the next app for your iPhone that does better distribution service. And I think a lot of this is based on kind of the trajectory that's been introduced by this common narrative of linear development. So they are like the whole idea of Web 1, Web 2, Web 3. That's utter nonsense, right? So if you want to create outsized returns, you have to be able to identify a paradigm shift. So that's, as a VC, that should be a superpower. If you can't do that, you cannot make useful investments and overall beat the other asset classes. You might as well buy an index fund. And obviously, historically, we can see that there's a very small number of VCs that have done that. So in our case, I think we looked at 5,000 or so projects and made investments in a dozen ultimately. But like we are big fans of not investing in dots, but in lines. So we keep an eye out on dozens of companies where we think that the founders significantly understand the bigger picture and where they fit, right? To see whether or not whatever they're building actually can benefit from this particular paradigm shift that is very obvious to some extent. A lot of people realize that certain things that we're doing right now cannot go on forever, right? So if it comes down to creating currency, if it comes down to how systemically we're addressing healthcare in the United States, things like that. So these are big topics, and then you can start slicing out a piece, but then hopefully you can benefit from a paradigm shift that can either be a technological one or a societal one. Sometimes those paradigm shifts are just in society, and people just no longer believe in a particular indoctrination, right? So again, coming back to that earlier Mickey Mouse example, is once I download a software client that lets me make free phone calls, and even if the country outlaws voice over IP, I'm still going to do that if the alternative is to pay $80 to call my relatives in another country. So in the US, I think specifically, because reality doesn't have an advertising budget, we are indoctrinated in all these false narratives. And unfortunately, again, I think a lot of the legacy VCs are to blame for that narrative. It's very sad. So I'm a big fan of, like, as I said, applying the scientific method to the topic and have peer reviews and have these discussions rather than trying to create a narrative and a marketing slogan to it.
Yeah, yeah. So I can tell you from what I see with angel groups and some of the micro VC that I'm involved with. So it's I think investments are still happening. but they're just taking longer. I think so. What used to take a 4 to 6 week, the due diligence is now a 3-month due diligence and goes through much more thorough analysis. It's not just talking to the founders, you're actually talking to the customers and actually make sure this is a real company and real business. And the market is actually there, because a lot of times market numbers the entrepreneurs put on show are actually kind of not accurate many times. So actually digging to see what real market size is, and so the result is diligence is taking much longer. So we typically do not invest in pre-seed companies. We want them to actually go through some of the accelerators and all those things and hone their business plan. And when they come to us, and we look at a seed stage investment, so where they're raising typically $1 to $3 million in their round. Not more than that, but somewhere in there. But that, so we have, even though there is investments going on, they're at a slower pace. And I think, as I mentioned before, the biggest challenge we're seeing is the companies we invested in 3-4 years ago are having a real difficult time raising their Series A, which is really critical to grow the company. So growth capital is actually extremely difficult to come by now. Seed stage funding is still available but after much more thorough diligence to be done. So it's so that's what we see at this stage. Yeah.
Got it. And that's an excellent point. And I think that's one of the questions that actually came in the Q&A window was about accelerators, which I will get to when we get to the Q&A stage, Damodar. So that's a good point about encouraging the startups to kind of go through an accelerator, polish their business plan. I think that's an excellent point that you mentioned. Lindy, as you kind of formulate your answer, I would love to also maybe have you share some of the international perspective. Obviously, 5 years ago, you and I looked at a bunch of deals in the Middle East, and I believe you did actually end up making an angel investment in one of the companies. And I know you've been to the region many times since then. And so I'm going to put a link here on specifically what the Indian Venture Capital Industry Association mentioned, how it's almost as an industry group, there's such a strong focus on micro VCs and what's happening over there. I found that very interesting. And I just realized a lot of these links I was posting was going to just the fellow panelists as opposed to everybody in the audience. So, okay, I'll repost some of those links for our entire audience. Let's starting with this one here. Lindy, if you can maybe share your perspectives on, maybe American startups looking at international micro VC funds or vice versa. I know we have a few startups, as Mohsen mentioned, joining from overseas. And so, especially in areas where capital markets are tight and private credit doesn't exist or is minimal, would it make sense to, for example, them to reach out to, again, micro VCs or angel investors stateside?
It is interesting kind of seeing that cross-pollination, across continents, right? And that, I think as you look at kind of, what were these nascent startup ecosystems, as they grow, one of the critical things actually are specialized accelerators. I think, especially kind of post-World Cup, you see a number of, sports accelerators pop up. There's a fantastic one, out of Spain and Israel, that does very well. To Christian's point, unfortunately, they follow trends a little bit, and that startups they're opportunistic in a different way than they are here. I think you see the era of kind of college founders. I will not say that's gone away. There are still some fantastic new founders coming up with ideas because they haven't been in industry a while. But I think the bulk of founders that we see have been in industry, identified a problem, and have the support network to come out and really solve that problem. You started this this portion of the discussion asking about economic indicators, interest rates, etc. For early stage companies that where the capital markets really aren't available to them, interest rates used to have more of an effect when they had a greater effect on the stock market. But now that the stock market is, quite frankly, somewhat divorced, from a lot of kind of traditional economic indicators, I think that actually has caused a bigger problem for early stage companies, because you have a lot of angel investors, who are like, the market's frothy, it's going up and down. I need to see this through. And that's had a very negative effect on early stage founders, where they get somebody who traditionally would be hooked into it, would be a perfect fit as an investor, but they're wondering what the market is going to do, and they're taking longer to invest, not necessarily because of the startup, but because of the ups and downs of the market. I think those problems actually have less of an effect when you look to Middle East, North Africa, India, Pakistan, where you have a significant amount of family wealth that is starting to embrace a very different asset class. And it was fascinating, over the last 15, 20 years working in the Middle East, and this kind of brick and mortar mentality shifting to a more, kind of pro technology, mentality. And a lot of that, was the creation of these accelerators, or, established accelerators, opening offices there, and not bringing just capital. Because as an early stage startup, obviously capital is a necessity, but everything from connections to startup founders who want to go after a problem, who are gritty, but who are also smart enough to know what they don't know. And those early stage dollars are critical, because they're with you. If you do it right, they're with you for 10, 12 years, and they're going to help set you up in the right way. And they're going to help point out the things that you can't necessarily see, because as a startup founder, you're doing everything at a certain point until you can really start building and expanding your team. And early stage investors, whether they like it or not, aren't just a check. And so it's interesting to see how it's shifted, but you can also see it. It's not just in internationally. You can see what's going on in the middle of the United States, right? You look at a lot of these companies coming out of Ohio, Oklahoma, right? There's a wonderful startup ecosystem that's begun there, supporting local companies. Startup founders don't just exist in the Bay Area. You have a lot of people, again, coming out of industry there are some very necessary problems that need to be solved, and they need to be supported locally, because you need to be in person more, and it's critical that there are good support systems for them, not to falsely prop them up, but that are good support systems for them, and understand how to really help these founders on their journey.
Absolutely. And it's such an interesting point that you mentioned, Lindy. Last weekend, speaking of Oklahoma, last weekend I was out in Martha's Vineyard in Massachusetts, meeting a bunch of accelerators, investors, high net worth individuals, and one of the companies there was actually Build Tulsa. I mean, it's a small fund that was set up by the city, as well as a few family foundations and family offices, encouraging startups to build in Tulsa, of all the places. Great cost of living, great cost of building companies. So I was very, very impressed by kind of hearing some of the startups that are being built out there. So thank you so much for that. Okay, wonderful. So we have a lot of incredible questions coming in on the Q&A, on the chat window. I think my panelists can see that. Also through our social media. So a lot of questions coming in. And one request I have for our panelists, if you can share your contact information. I'm sure our audience would love to stay in touch with you, ask any questions. So email address, phone number, or whatever else you want to share. Your LinkedIn profile will be very helpful for our audiences. And with that, I'll go to the QA to pick so many good questions. Maybe staying on the topic of capital markets, Paul is asking, with the decline in IPO liquidity exits, I've seen a shift to, quote, staying private longer. While some of this may shift when rates decline and deal activity increases, fingers crossed, do you see any newer methods for liquidity in the private markets? For example, in Series B to C, or I mean, you guys can extrapolate, even A to B. Are there opportunities for partial or full liquidity for early investors? Again, I know I'm hearing a lot about secondaries. Again, I don't know what the appetite is, but would love to hear from the three of you. And if you can limit your answer to maybe less than a minute. I know it's very difficult given how kind of complex the question is, but that would be helpful because I do want to get to as many questions as possible. So maybe again, starting in our usual alphabetical order, Christian, Damodar, and then Lindy, that would be great.
I don't have any particular insights. I would just second what you said about the secondary markets. We usually have an expectation of holding positions for a decade. So, and we would help anybody and usually buy out the investor in our case, right? So we don't have an expectation of early liquidity outside of what we like to see, and that's just part of good governance, is essentially keep a company in or project in a shape that allows it to go to the public markets if and where there's a window for that, right? And ultimately, I assume that there will be windows opening up again. So that's typically what we advise our portfolio companies to do, and just position yourself to be able to capitalize on that.
Got it. Damodar?
Yeah, so I think, yeah, so some of the ways we are seeing liquidity for the founders to happen is actually in the next round of financing, they sell small number of their shares as a part of the, that way they get some cash to sustain their lifestyle, because running a startup is very, very difficult. So you're really, so having some amount of financial security during that startup building phase is important. So I think some investors do allow that, not a large chunk of shares sold, but only a small chunk as a part of an investment round. So there are multiple sources nowadays for secondary markets, but I'm not sure they're very well developed to trust them at this stage. So I think best one is to get it through your investor to buying it. So actually have one company that we invested in. Founders are selling 5% of their stake as a part of the next round, and they're making a few $1 million, and they're happy with it. So they can build a company for next 5-6 years without worrying about money. So I think if there are opportunities like that, founders should look at them. Yeah.
All right. Wonderful.
No, I think that's spot on, and I think it depends on the stage. I think that's right for earlier stage. It's interesting to see how the capital markets have shifted for later stage for DEF. Especially as a lot of companies are not pulling the trigger on going public. Right. I mean, you have different trends that pop up, SPACs and all these, different things that are created. But this is where the larger later stage VCs are critical for that ability to, to buy shares, create liquidity. And as you're not talking about 10, 20 person teams, you're talking about 1,000, 10,000 person teams. The capital markets, I think, have to shift to accommodate that. And I think what I've always been, what's neat about finance is that ability to shift and to create a new mousetrap, as it were.
Sure, absolutely. So unfortunately, folks, we will have to leave it at that. Again, a lot of good questions, but thanks so much for sharing your contact information. I would encourage those who ask the questions to reach out to our panelists directly. So again, thanks so much for taking the time today, Lindy, Christian, Damodar, really appreciate it. With that, now we'll move on to the presentation, folks. The presentation part of the event. Again, folks presenting from around the country and actually around the continent. We have presenters from Virginia, San Diego, Vancouver, Canada, New Haven, Connecticut. So again, good luck to all the presenters. I'll be rooting for you. And again, really, I also really want to thank our panelists for taking all the time today. Please stick around. Would love. I know our companies that are presenting, our portfolio companies. Would love to get your feedback, would love to get your insight into their presentation, their business model, their ideas. So again, thank you so much for taking the time today. Nosheen, back to you.
Thank you, Ike. Thank you, Ike, and our panelists. On behalf of everyone who joined us today, we sincerely appreciate all of the wonderful insights and perspectives shared by our panelists. Before I announce the startups, let's quickly go over the house rules. Each presenter will get 6 minutes to pitch, followed by 2 minutes of Q&A session. After each feedback session, we will conduct a poll for you to rank the presentation and seek investor introductions for the startup. There will be a feedback form link provided in the chat feature for attendees to fill out. It helps us maintain and improve the quality of our events, so please don't forget to fill the link. And with the house rules clarified, I am super